Here's what an ARM interest rate is, how you can save some money with it, and why you probably shouldn't. This is Tom Kalagher with Fairhope Mortgage. An ARM interest rate is one that starts out with a set rate for a certain amount of years and then can adjust every so often. So for example, a 3-1 ARM means you have a fixed rate for the first 3 years, and then every year after that it can adjust based on market conditions. ARM rates are often lower than a 30-year fixed rate mortgage rate, so you can save some money. It can make sense if you know for certain you're going to be moving in the next 3 or 5 years, because you can get a 3-year ARM, a 5-year ARM, or a 7-year ARM. But here's why maybe you shouldn't do that. You might save a 0.5% of interest or a whole percent of interest and have a cheaper mortgage payment every year for that fixed portion of the ARM. However, after that, it can adjust based on market conditions, and no one can predict what interest rates are going to be 5 years from now. Now, a lot of people will say, hey, I can just refinance. If market conditions change and interest rates go up even higher, I can refinance and get into a 30-year fixed rate mortgage. However, that's not always the case. There are certain unforeseen circumstances that can stop you from refinancing. Let's go over a few of those. One example happened in 2008. Interest rates went up, house prices went down, and people were stuck in mortgages, unable to refinance. I'm not predicting that we're going to have a repeat of 2008, nor that house values are going to go down that much, preventing people from refinancing. But the fact is, there's always that risk, and a 30-year fixed rate mortgage helps alleviate that risk. Other things that could happen is you could lose your job, and because of that, you could miss some payments and have your credit score go down. With your credit score down, it could be difficult or even impossible to refinance, and you could be stuck paying whatever the going rate is at the time, and we don't know what that could be. If you change to self-employment, we need a 2-year history to average your income or your commission checks. That's how we calculate income on self-employment. So there'll be a 2-year history where it's very difficult to refinance. These are just some of the things that could happen, causing you to not be able to refinance in the future. Now, let's say, for example, you don't go with the ARM and interest rates go down. Now you're in a fixed rate mortgage. It's relatively inexpensive to refinance to that lower rate anyways. So while an ARM interest rate would allow that rate to come down naturally as rates come down, we could do the same thing with a refinance, and the cost can be mitigated quite a bit. You may even be concerned about constantly going back to a 30-year mortgage and never paying the loan off if you keep refinancing. That's not a problem. We can refinance to any amount of years you want. We could do the standard 30, 20, 15, and 10, and I have programs where you can actually do it to like 27 years if you're 3 years in and you want to stay on that 30-year term. So there are a lot of different options to make sure that you're paying off principal and getting that mortgage paid off. If you want to learn more about how to save the most while mitigating your risks, give me a call, Tom Kalagher, Fairhope Mortgage. Thanks for watching.